Our presentation is over Chapter 7, Scholarships and Prizes.
Before 1954, there was no specific code section that specifically regulated the taxability of prizes, awards, and scholarships. They were excluded from income only if they could be considered a gift under Section 102.
In 1954, Section 74 was enacted. As an overview, this section includes most prizes and awards and gross income, but there was an exception for awards that were based on religious, charitable, scientific, educational, artistic, literary, or civic achievement, so long as the recipient of the award was chosen without action on their part to enter the contest and was not required to take further action or render future services.
Also in 1954, Section 117 was first enacted, excluding scholarships and fellowships from gross income for both degree candidates and non-degree candidates, subject to certain dollar and other limitations in the case of non-degree candidates.
We will first focus on prizes and awards. Typically, these are going to be taxable. In 1986, the exclusions were narrowed with the addition of Section 74B3 to the code.
As stated before, prizes and awards are generally taxable. Prior to 1986, meritorious achievement awards were given special tax treatment, but the code was updated in Section 74B3, and they are now taxable unless a qualifying exception is met. In order for meritorious achievement awards to be exempt from taxation, the receiver must transfer the award to a qualifying governmental unit or organization in Section 170C.
To avoid taxation on this award, a timely designation must be made and carried out before the award is used. However, if the receiver does not designate a Section 170C organization prior to receiving the award, they still may later transfer the award subject to Section 170B. The receiver will then be subject to the percentage limitations of 170B. Section 74B3 would then be more beneficial to a taxpayer to divert funds received without the limitation of Section 170B.
We will next discuss the principal exclusion in Section 74, Employee Achievement Awards. An Employee Achievement Award is an award given to an employee by their employer in recognition of a qualifying length of service or achievement restricted to personal property, not including items such as cash, most gift cards, meals, or lodging.
This is limited to $400 per year for each employee. It is notable that there is an exception for qualified plan awards or employee achievement awards under a written plan, where the maximum is raised to $1,600 per year. These are covered in Section 274J2.
For these Employee Achievement Awards, they may be excluded from the employer's income if the cost of the award is fully deductible to the employer. If this is not the case and the cost of the award is not fully deductible to the employer, the award will be gross income to the employee to the extent its value or cost exceeds the deduction limit.
As an example, say an employer gifts an employee a watch worth $600 that the employer purchased for $500. The employer's deduction for the watch may not exceed $400 pursuant to Section 274J2A. Because the cost or value of the watch exceeds the deduction limit, the employee must report gross income of $200 for the watch.
Next, we will take a look at scholarships. They are excludable so long as they are qualified scholarships. The recipient of this scholarship is limited to degree-seeking candidates at qualifying educational institutions.
A candidate for a degree includes students attending a primary or secondary school and undergraduate or graduate students pursuing an academic or professional degree at a college or university.
Congress limited the scholarships in Section 117A to qualified scholarships. This limits the funds to qualified tuition and related expenses. Tuition, fee, books, supplies, and equipment all fall under this provision.
While you are not required to trace the funds, there is no exclusion for non-qualifying expenses such as room and board, travel, and incidental living expenses.
Often, students who work for universities may attempt to classify their payment instead as a scholarship. This issue is often phrased as whether the payment is made for a scholarship or fellowship or compensation for services.
Litigants typically lose these cases, and their payments will be classified as compensation for services. However, there is another exception for employer-provided educational benefits in Section 117D that allows employees to gain education below the graduate level tax-free.
To illustrate these concepts, we will now take a look at a couple cases dealing with these issues. First, we will consider the holding of Bingler v. Johnson.
In Bingler, medical interns and residents trying to case their remunerations as fellowship grants lost and were required to classify them as income.
Now we will take a look at a case out of the United States Tax Court, McCoy v. Commissioner.
There, the petitioner attended an annual sales contest where his employer, Hot Point Appliance Sales Company, distributed awards to the winners. The petitioner received a new 1957 Lincoln Capri presented to him at a banquet held in Jacksonville, Florida. The company paid $4,452 for the car. He then drove it to his home in Knoxville, Tennessee.
After owning the car for 10 days, petitioner had the car appraised and traded it to a dealer for $1,000 cash and a 1957 station wagon, which had a value of $2,600. He included that combined amount of $3,600 in his gross income for the year as the value of the Lincoln automobile he received as an award.
The petitioner argues that the $3,600 represents the fair market value of the Lincoln, since that was the amount he realized when he traded it in. He believes that the $4,452 his employer paid for the car does not represent its fair market value to him.
The respondent argues that the petitioner owning the car for 10 days and driving it from Jacksonville to Knoxville depreciated the car below its value at the time he received it, which the court agreed with. However, they also agree that the $4,452 paid by the employer is also not an appropriate valuation of the fair market value to the petitioner because he had not had a chance to use the vehicle yet.
Therefore, the court exercised its best judgment and concluded that the proper fair market value of the new car was $3,900 at the time it was received by petitioner, and this should be included in his gross income. Finally, we will take a look at an interesting provision within Section 74. A special exclusion is made for winners of Olympic medals. Due to the value of an Olympic medal, worth near $800 in materials alone for a gold medal, or upwards of $20,000, this would result in a clear accession to wealth.
Section 74D gives Olympic athletes an exemption from taxation for the value of any medal awarded in or any prize money received from the U.S. Olympic Committee on account of competition in the Olympic Games or Paralympic Games.
This has been our presentation on Chapter 7, Scholarships and Prizes. My name is Sarah Cronenberger.
And I'm Morgan Register.
And thank you so much.
It's right there.
No, that's not gonna stop it. Oh wait, no, if I just end the stop share and then it'll save it.